That's impossible for us.
Yeah.
Yep. Okay, I think we're live, and we're going to kick this off as fast as possible, but welcome everyone to today's webinar on node infrastructure and why it's important, presented by Blockdaemon. Today we have Konstantin Richter, CEO of Blockdaemon, Meltem Demirors, Chief Strategy Officer at CoinShares, Sam Lessin, General Partner at Slow Ventures, and Anatoly Yakovenko, I think I said it right. All right, close. Co-founder of Solona. And we are going to, again, to talk about node infrastructure. Really exciting week. Hopefully we can bring some energy on this topic. But we'll hopefully answer why this matters, what it means for network stability and integrity, why decentralization matters and the degrees of which decentralization exists, among other things that come up. To kick us off, though, we're going to have Konstantin give us a quick introduction presentation. And with that, I'll pass it over to him to get that started.
Cool. Well, thanks for the intro. I'll riff a little bit on a few common points when we talk about node infrastructure, which is explaining what nodes do. I'm going to talk about decentralization, very, very popular philosophical concept. I'm big on philosophers. Decentralization is an interesting one. And talking about the degrees of decentralization. And then we'll briefly talk about some of the use cases around nodes so people understand who's actually using these nodes and what for. And so I'll try to keep it very succinct and informative. And so why are nodes important? When we talk about decentralized ledgers, the ledgers live in individual nodes, and nodes have three components: storage, copy of the ledger. There's a software compute often an error, a component that actually contains the software and client of the protocol. And so when we talk about Bitcoin or Ethereum, like that's where that software lives. It has the consensus mechanism within it that dictates the node's behavior based on how other nodes behave. And that's the third part, is the peer connectors and the connectivity of the node. And so the configuration of those three components tells you what protocol you're dealing with. And so when we talk about Bitcoin, Ethereum, all these other protocols, they all have a different version of how storage is connected to the consensus and how they connect to other nodes. And so each protocol, unfortunately, has a unique configuration of what that looks like. And thus, there's enormous complexity there. You do need nodes. Nodes have a lot of different roles in the network. Nodes validate blocks of transactions and confirm that they're correct. And so when you send a transaction via Coinbase, very popular name these days, then what they do is they submit a transaction through a node they run in order to ensure that the transaction hits the block. So anyone who actually wants to send around stuff needs to run a node. The node also can contain the complete history of every transaction that has happened in a network since Genesis. It's not a requirement, it's a choice. If a node wants to go back in time and re-index every transaction until the beginning of a block. And we'll talk about what type of companies need nodes like that. And nodes communicate with each other, and they send information across the network. So we talked about that a little bit. So nodes are, when we talk about the other block, the chain component of nodes is ultimately, they weave the blockchain. And so when people talk about effective networks, one of the things you'll hear a ton is it decentralized or not? And you'll find that every protocol has its own fan group, and they will rationalize why they are more decentralized and more legit as a digital currency than the other project. And so it's important to understand that decentralization is a different thing to different people. Nothing is fully decentralized. There's always single points of failures. Earth might blow up. We're all going to fall. And so decentralization incorporates different computational components, consensus components, as well as network diversity. And so there's different degrees, and I want to talk briefly about it. So first off, an important factor is decentralization. For a good decentralization looks different over time for a protocol. And so protocols, like any other project, have life cycles. And so they start at a certain point, and there might be 3 nodes, and then people get onboarded, stakeholders, functionality gets built, liquidity enters the protocol. Decentralization looks different at all these different stages. And there are different categories to consider when you evaluate decentralization. So there's data center diversity, territorial diversity, operator diversity. Are they all controlled by the same entity or not? Token distribution is a big factor when we talk about decentralization. Tooling diversity. The further evolved an ecosystem becomes, the more you need to think about, again, single point of failures. And so if everyone uses Docker containers to deploy nodes in a cloud and there's a security vulnerability in Docker, then can that be exploited and jeopardize the integrity of a network? And so effective decentralization is economically very, very hard to achieve. And we'll talk a little bit about that because it's counter to economies of scale. And so there's an inherent complexity here where we've yet have not figured out between proof of work and proof of stake an economic incentive that works, which is to avoid that large entities will group power by different means, via accruing a lot of tokens, via hash power, via different ways to go about it. And so there's this is a very, very hard thing to do in a public manner. There's permission networks that actually do a very good job. They get hit on a lot. Like I'm mentioning Diem, for example, where there are single points of failure maybe around the entity Facebook that controls a lot of it, but in the setup of the association and stuff, they try to very effectively counter a lot of that. And so little actual difference between public and permission networks over time. So the reason why I say that is because a lot of people, oh, this is a permission network, it's by definition crap. Is actually not true, because a lot of permission networks are more decentralized than some public ones, for example. So that's not in itself an indicator. And so the other big thing, we as a company, the statement we've always made is that decentralization requires democratization of ability to operate nodes, right? Is so offer tooling and educate people so a lot of different people can run nodes. The rule of three, the slide got a little cut off. I was still drafting it prior. But I kind of feel like 3 is an interesting number because when we talk about consensus, a third of a network is a very important inflection point normally. And so no matter how you describe it, and it's a very logical, simple thing, which is, if you have 2 people, it's hard to be decentralized. Once you have 3 independent parties, 3 people will quibble, you actually have a degree of decentralization. So 3 is always an important number when it comes to decentralization. You can make arguments that there's 3 different groups in Bitcoin on hash power, for example, that control decentralization. And so as long as you have 3, you are in theory to some degree decentralized. And I call that the first degree of decentralization. And so I'm gonna very briefly walk you through Konstantin's random, poorly thought through degree of decentralization score, okay? And so first degree of decentralization is at least 3 independent parties in at least 3 different data centers and territories. Like let's say the bare minimum of what you need is a node on Amazon in Europe, 1 in Google in Asia, and 1 on Azure in North America, controlled by a separate entity. The second degree of decentralization, the next number that gets interesting normally is 21 nodes. It's something we've seen in a lot of networks that sort of gets flown around. And the reason why I want to mention it is because there's a lot of examples of networks like Stellar, EOS, that have validator nodes that sort of clog out of between 20 and 30. But if in these 21 nodes, you have no more than 7 nodes in any cloud controlled independently, you achieve second degree of decentralization. Most projects never get there. 95% of blockchain projects never get to this point. It's super important to understand because it's not about quantities of nodes. It doesn't matter if you have 10,000 nodes or 21 nodes. If the control mechanism governing the 10,000 nodes, if you have 8,000 nodes controlled by X amount of people, or if 1% of large holders control, stake, and vote in a particular network. And so most networks fail at that or stop at that part of the chain. And it's important to understand that it's often 21 is good enough, depending on the state of the network, because there's a core technical requirement. These networks need a function, and they need to be able to onboard liquidity so they can actually be used for something. And so the what I call the third degree of decentralization is actually 21 nodes with diversity and performance, so software updates can be processed by all 21 nodes within 60 minutes. And so the reason why I mention that is another thing that happens is networks can go down because there's not a centralized entity running drills and stuff, but those are things that matter. And you'll hear of large networks suddenly stalling for half a day. It's because they're not decentralized to that manner where there's enough large entities that are able to sustain the network when tough things happen and need to happen quickly. And so that's actually a much more potent indicator of quality and decentralization is, can a network sustain something like that? And then the fourth degree is that you have 21 nodes and a tooling landscape that allows liquidity providers to dynamically reconfigure node power within minutes to ensure liquidity. So networks can go down, so can exchanges and custodians. And if you don't, as a community, work on providing tooling and infrastructure that allows these exchanges, for example, to suddenly have 100x more transactions hit their nodes, then you'll see Coinbase, all other exchanges, they continuously go down. And so the tooling landscape and network efficiency is a very important component of decentralization as well, because if you can't guarantee that tokens flow seamlessly, then again, you create it's easy to have single points of failure. And so that's the fourth degree of decentralization. And then the last is nodes plus, so more than 21 nodes deployed as above with 21 different open source DevOps tools by individual entities. And so that's when you come into clients. Something Ethereum probably comes the closest to this, when you actually have very rich tools and a strong community supporting lots of tool development, testing, and strong institutional support. It's still very often that you don't have more than 21 equal stakeholders, but you have the ability for people to very quickly shift and participate in networks. And so if you have both, you have a decentralized network. So I'm going to pause and stop here. So I just wanted to kind of, none of this is all arguable, but I figured it's interesting to talk a little bit about the other components, but individual, just, there's 10,000 nodes in this networks, thus it's better when you look holistically at these networks. So let's stop here and start talking.
Nice, thanks, Konstantin. All right, so let's dive right in. I think that was a good base to start from. I kind of want to zoom a little bit higher level to start the conversation. But this is coming from someone, and I don't know why I was put on this panel, but my experience with nodes is very limited. It's started in 2021 through Umbrel. And for those that don't know, Umbrel allows you to, I guess, and then this is where I could help explain what's actually going on in the background. But using a Raspberry Pi, I get to run Umbrel software, which effectively allows me to run a node. I think it's funny, I waited about a month for the node to fully sync. And now that it's synced, I'm kind of just looking at it and not really sure what's going on or what benefits I have by doing this. So I think a very first question that I would have to open this up would be, what's the big idea, first of all, of what we're trying to build here? And how do nodes play into that from an infrastructure standpoint? And I think I'd want to start that with Meltem. I've seen you comment on this over the years. So maybe specifically for Bitcoin, as Konstantin kind of pointed out, this looks very different across chains. But for Bitcoin specifically, what really is the big idea behind running your own node and why that matters for this network?
Yeah, I think those are great questions, and would love to share my perspective. I've been working with Konstantin. So little known fact, we met each other back in 2016. Konstantin came to the DCG office and we were chatting about a project he was working with, and he was like, hey, I have this crazy idea. I want to build like the Amazon of blockchains. And I was like, what do you mean? We started talking about it. So we've been kicking around this idea for a while, and it's been really amazing to see like how prescient Konstantin and Blockdaemon team have been in terms of what they've built. But really, here's my view, right? One thing that people don't appreciate about the Bitcoin protocol and the Bitcoin network and other crypto networks is these are really giant communication protocols, right? Bitcoin, I like to say, is the largest privately owned telecommunications network in the world. What we happen to communicate is value, right? UTXOs and information about transactions. And a lot of people don't understand at its core how a Bitcoin transaction works. There's 4 basic steps. I'll just outline them really quickly. You create a transaction. The way most people do that today is through a third-party service provider like a wallet. But when you're using Blue Wallet or Coinbase or another platform and you generate a transaction, what they're doing on the back end is creating a transaction. That transaction gets broadcast to the Bitcoin network, which is a network of all of the computers in the world who are running full nodes, right? Those full nodes have a full copy of the Bitcoin blockchain. They verify that that transaction sort of qualifies based on the rules of the protocol. And then that transaction gets propagated. And then once that transaction is propagated to all of those nodes, it gets sent on to be mined, to be hashed into the next block. That's where the transaction fees come into effect. And then miners sort of, process transactions based on the fees attached to them. So if you attach a very low fee to your transaction, it's unlikely that a miner will append your transaction into the next block on the blockchain. They'll choose a higher fee transaction to sort of mine into the next block. But at a high level, effectively what you're doing if you don't run your own infrastructure is you're relying on a middleman to relay transactions to the network for you. One of the interesting things, right, that I always think about is in the early days of internet peering, a lot of enterprises had to run their own infrastructure. In the crypto space, nobody thinks about running their own infrastructure. And if you're running a communication protocol, right, and all of these blockchains are communication protocols driven by consensus, right? And if you're not managing your own communication, you're susceptible to various types of attack vectors. So I think one of the core components that starts to become really important now that the crypto ecosystem, and in particular Bitcoin, is a multi-trillion-dollar market and Bitcoin is a multi-trillion-dollar asset class, if you care about your Bitcoin and your Bitcoin transactions, you should also care about the underlying infrastructure that you're utilizing to support your ability to broadcast messages to the Bitcoin network. And so I think about it really from a cybersecurity perspective, but also from a financial security perspective. And in different protocols, the rules vary, right? But if you have multiple billions of dollars or trillions of dollars at stake, why would you rely on a third party to manage your communication infrastructure? Why would you rely on a third party to manage your compute and connectivity? And so I think as the relationship between the underlying physical infrastructure and these protocols becomes more apparent, and as we see more threat vectors emerging, I think more and more institutions, corporations, governments, and individuals like you, Ryan, myself, Sam, and Anatoly, right, will start to realize the importance of running your own communication infrastructure. I don't rely on someone else to send my text messages for me. I do that myself. Why would I rely on someone else to push my own transactions to the network, right? So I think, again, we need just a fundamental rethink of what we're doing here. And again, I think it's so critical when you're participating in one of these networks to understand what it is you're actually doing with your information.
Okay, so that was great. So then my follow-up would be then for Konstantin, how do you balance that perspective with this idea of what Blockdaemon does, which is what I understand to be, I guess, blockchain infrastructure as a service? How do you allow, I guess, enterprises and people to still get some of those benefits that Meltem kind of laid out, while still, being the company that wants to be this Amazon of blockchains and providing that infrastructure for people?
Yeah. Well, and first off, it's important to go a little more context what Meltem said, which is the node you run on your Raspberry Pi doesn't aid the network at all, just to be very clear. Yeah, and so it's important to understand. So there's, again, different factors that indicate the quality of a network, right? And so the how many fully synced Bitcoin nodes with the correct software do people think are actually currently live in the world? And people, it's around half, and it's less than 5,000. Yeah. And so, and it's interesting when you talk about an asset class of that size. The main reason is because people who run nodes very often forget to update it. There's a reason why this is complicated, which is these networks are run by nonlinear foundations. You don't know when something drops, right? Like there might be an update, there might be something happening that'll require you to rejiggle the balance of what the configuration of a node looks like. There's also a lot of different types of nodes. And so there's nodes that validate transactions, but there's also nodes that, for example, might just be a data pool or something. There's a lot of different types and variances of nodes. And what Blockdaemon does, now we aid decentralization, is we're on the institutional layer. We ensure that institutions run nodes that aid the overall performance of the network, right? And so what that means is that for nodes to be, and for a network to be efficient, you don't just want all nodes by us, but you want certain nodes that have a lot of throughput managed by us because you want to ensure that they work all the time. right? And so that's actually a much more important factor when it comes to decentralization. And I think the other thing that, the evolution around the Amazon concept for us is obviously we see ourselves more like a data dog, for example, which is ultimately we allow an entity to run their own node, right? And so that's what we do. Now we have a managed service around that if you don't want to rejiggle your node, but contractually and legally, it's entirely your node down to the access points that you control. But to Meltem's point, the important point is when we run a node for a customer, they're the only ones who have access to that node, which is normally, and so that's really what they reserve is we want a node where our transactions exclusively hit that node. And that's the biggest use case for this, because otherwise, to Meltem's point, if you don't run your own node, you're relying on another node to prioritize your transaction. And so, and that's actually the biggest use case here for an exchange, for a custodian, for large financial entities who wants to make sure that they can process 100,000 transactions in an hour. And what you'll find is that they actually can't physically do that at scale, because in order to do that, you need to support, let's say, you have 50 protocols on your website as an exchange. You need to operate 50 high availability node clusters in order to have perfect performance over time. That's a team of 100 engineers that just does that, right? And so it's important to talk about, like, that's sort of our current customer base. And then over time, the tools we build and what we learn, we open source and make available to the public, so individuals and smaller entities can also use these tools to run high performance nodes over time. So I would say that we're overall an engine towards decentralization. We guarantee liquidity. We also ensure latency on a network architecture, which is making sure that the network doesn't stall and transactions get wired to the closest nodes in the network. And so, it's an interesting complexity behind it, right? Like what nodes actually add value to a network.
Well, and also very importantly, Konstantin helps people like me who have squirrel brains and can't pay attention to one thing for a very long time. He manages all of the node infrastructure supporting the assets I own and our organization owns, right? So, I think for an individual, you're not always tracking, it's happening in 30 different protocols. So being able to rely on Blockdaemon to do that, I think is great peace of mind. Otherwise, we'd be in a dire situation with everything that's going on in crypto markets.
Amen to that. That's helpful. Then I guess the next follow-up would be, when you think about that example Meltem just gave, all these different chains, all these different requirements, and they look completely and operate completely differently. And you kind of mentioned this idea of like rule of 3 and 21 nodes. We have a question in the chat that I think kind of relates to this, but what is the ideal amount of decentralization a protocol should strive for? And how do you guys help to ensure that, Konstantin?
Yeah, I'll be brief because it's totally subjective and also dependent on the state of the network and architecture of the network. And so a network can be fully decentralized with 21 nodes or with 21, the quantity of nodes is not the only factor. And so it's a factor and variation of the things I've discussed, which is ultimately tooling landscape, diversity in ownership of nodes, where they're hosted, which clouds, data centers. And so there's technical components and consensus components that play a factor into it. And I'd say what is important changes over the stage of the life cycle of a protocol. And so there isn't a fixed answer. It just means that these networks grow, right? Like Solana, and actually Anatoly can, I'm sure, talk to that, for example, is a network that's relatively new, has 500 nodes on the network. There's a certain degree of centralization, but it helps them to also manage network performance. And so over time, it's going to get a lot more vast, but it'll look different, I guess, over time.
I guess that's a good segue for Anatoly and how you think about, with Solana and Konstantin mentioned that this is obviously a newish network relative to other smart contract platforms. But what are the factors that help with network stability in your view, and kind of the trade-offs that Solana's made, and how that impacts nodes on your network?
Yeah, for sure. So kind of as Meltem said, that these are communication networks. This is really like fundamentally a way to pass information. And the way we've been thinking about it is that the core thing that we're maximizing is that minimum set of entities that add up to 33%. Like the rest of the network actually doesn't matter as much as that smallest set of individuals that can get to that threshold of liveness, because once that set is corrupted, they can basically control the order of all the events that pass through this financial system. And if this thing is running exchanges, markets, etc., they kind of control those marketplaces. So we've been, relentlessly focused on that. And this is why, again, like our design and everything we're doing is about hardware optimizations, because to grow that set to a size that like somebody like Sam, who knows tech but isn't like a core engineer, can look at it and be like, oh yeah, okay, this is secure. Like at a gut level, that needs to be like thousands of entities. And that just needs more messages per second, more hardware, more ASNs, more data centers, more endpoints. So, we started with 40 nodes when we launched a year ago. It's over 500 in mainnet now. Our testnet was just kind of our boot camp for new onboarding validators. There's 1,400. So those folks are going to jump right in. But the hardest problem has been actually getting investors and people that are kind of, lazily paying attention to these things to actually spread their stakes out. Like on testnet, we have, to get to 33% is around 300 or over 200 independent entities, like over 200 independent validators that have put up these nodes and these co-locations and like built these boxes by hand, right? Because we can control all the stake distribution there. And that's bigger than any other network in the world right now, I think by a factor of 10 to 20. But on mainnet, it's about 12, which sucks, right? It's barely better than EOS, which ironically is doing better than proof of work networks, where like 3 Ethereum mining pools at up to 51%. So that's been the hardest problem, has been now for us, not on the tech side, but more on the social, like education, like that component. We're building tools to make that easier, right? But this is like the biggest challenge, I think, over the next few years for these systems to get to level of maturity to handle $1 trillion of volume is going to be more educational, I think.
Well, and I think the trade-off between like your personal financial interests and like the health of the network, the short-term, long-term trade. Like, for Solana at Slow, we stake with Konstantin, but also with other people, right? And the reason we do that, but you shake your head, but you want me to, right?
Yeah,
because,
yeah, I agree.
Because we have enough. We're not 20%, but I'd like to think we're a little meaningful, right? That like it's in our, we believe, long-term interest to promote many people staking, not just, one. The problem is, I would actually argue that in the short term, we pay a strict economic penalty for that, because when you think about like the rewards we get, we could probably make slightly more money, right? Like if we were just like, look, race to the bottom, whoever's going to give us the most reward wins, right? Like, and I think that's like an interesting problem. I think long-term incentive, just like running a Bitcoin node costs money, right? Like, but if you have a lot of Bitcoin, paying a small tax, right, effectively for the health of the network makes sense. Candidly, it's the same thing with Meltem's hobby horse, which is greenness and offsets, right? Which is like, look, it's totally rational, I think, from the long-term perspective for people who care about this stuff and believe in long-term health to be doing like things like Bitcoin offsets, right? Which aren't super expensive, but they're also not free. But I think it's kind of the right, if you think about short-term, long-term optimization, these are slight taxes that like part of being a permissionless open system is like this thing. And then what we want to avoid is what I call like the tragedy of the commons, where everyone is so greedy to the last cent effectively that you don't promote that healthy ecosystem long-term, right? And everyone kind of races for maximum fees, minimum price, not enough people can support running nodes, not enough people are doing carbon offsets, etc.
Yeah, and one important, just because it's one thing I didn't get to, is it's a concept we call network custody, which is not custody of tokens, but custody of the security of the network. And as a node operator, we care a lot. And so Sam is absolutely right. We encourage people working with a lot of node operators, because over time, our business model is based on, we want these networks to scale and institutions to onboard onto them. But I want to break a lance, like to Sam's point about Slow. It's actually very rare. I mean, we obviously run a lot of investor nodes. We speak to a lot of people. And I'm always amazed that there's huge holders of networks trying to get like a singular deal at the lowest possible fee with one provider to maximize return. And you're kind of like, this is so against why you invested in this network, but it's fascinating, you know?
But I think the other wrinkle to add to that, right? Like at CoinShares, one of our core businesses is asset management. We have 5 billion in assets under management across a number of different protocols. And one of the challenges is, right, we are a fiduciary for other investors. And so the question is, you know, as we see more and more asset management products emerging in these different protocols, particularly proof of stake protocols that require active participation, what are the implications from a governance and fiduciary responsibility perspective of having staked assets in a structured product format? Right? Are we going to allow, if there are protocol decisions that need to be made, right? Do we appoint protocol politicians? Do we have proxy votes whereby our certificate holders vote on what outcomes they'd like to see? Do we spread our assets among several different delegation partners or staking partners in the network? Like, they're very real questions. And actually, this starts to bleed more into the world of corporate governance, which is a key issue, right? We've seen it time and time again in traditional finance. Similarly, I think we're just at the starting point of exploring what protocol governance looks like. Obviously, there are like a number of different primitives emerging around the protocol governance space, and it's an area, you know, a lot of us, I think, are tracking closely, but it is still really challenging because, to Toly's point, there are really only, like in each protocol, a small number of parties that are really deeply invested in understanding the complexities and the nuances of different protocol upgrades. And because the consensus mechanism of each protocol is so different, right, really a firm that has, you know, maybe 30 positions can only really be an expert in 1 or 2 per analyst or associate. And so I think one of the things we haven't seen is enough financial support and enough human capital from investors and allocators into actually understanding how to support protocols. And for this to really grow in a healthy and sustainable way, we need people allocating not only to, you know, raising AUM and having a lot of assets on their platform, but also actually participating in these protocols in meaningful ways, which, you know, in my view is still very nascent. I'm curious to see what it takes, like maybe a large-scale coordinated attack, you know, and multiple public blockchains with billions of dollars of value have had 51% attacks. That's what's so insane to me. Like, there have been numerous block reorgs in different protocols, yet people just don't seem to care. So I don't know what it's going to take to get people to build this.
And look, I think this is, again, I agree. I always put this on human terms. I always think about this as like, look, it's hard enough to be an engaged American citizen, right? Imagine that you're now a citizen of 50 different countries around the world, right? Now, the good news about crypto, unlike the United States government, right, is like, broadly speaking, at least for now, everyone can agree that like the like value of the network is the point. So at least as an objective function, right? Broadly speaking, it gets confusing when there are shorts and DeFi and like all sorts of products that might make that not true, right? But like, so long as everyone's coordinating that's one piece. But then, yeah, I mean, I think like, look, it's the whole, like, it is extremely complicated to think through exactly what you're talking about long term. It is kind of like, how do we write constitutions again, right? How do we do this in a way that people can approach? Who's really, I mean, we all get that with proof of stake, at least it's, you know, one coin, one vote, or whatever you want to think about it that way, right? But like in the end of the day, like it's a really interesting, very human set of like incentive and governance problems where like I actually think crypto hasn't really innovated. It kind of has, but not really, right? Like it's innovated on a lot of things, but like no one, sorry, that's me getting off a cue. No one yet has good answers there.
Wait, Sam, is that your AI like nudging you?
No, I will admit I'm actually trading while we talk. And
Nice.
I hope you're not trading Solana.
No, I can't. I mean, my Solana is so locked up, I could never trade it even if I wanted to.
Jokes. Jokes.
We're famous for the bullish unlock.
But it's an amazing point you just made, which is ultimately when we talk about systemic governance in crypto and protocols, obviously there's such a huge human component to it. And because it's so deeply woven and directly woven into greed, that's what makes it so interesting. And so it's a lot more truthful, but the tooling around it, and one of the products we're working on with some of the larger financial institutions, for example, is how to manage governance directly and delegate governance to individual account holders who have a fraction of tokens. The problem then is they're never really informed enough to understand the nuance of issues. And then you're back to, when the Constitution was drafted, you suddenly have delegates who need to manage it. And so it looks very similar. We acquired a company called Looney that did governance decisions in a UX across protocol for users. But ultimately, those are very heavy users. And so ultimately, I think you'll have companies that will apply for your proxy over time and manage interests in respective protocols. But there's a lot of technology that you can actually enable.
Well, I mean, you're back to the same free rider problem, right?
That's right.
Right. This is which is basically like, all right, cool. I'm going to hire a proxy.
Yeah.
Costs money. I'm either going to hire the cheapest fucking proxy, right? Because I'm going to be stingy to the last cent on this in a short-term incentive.
Or the most entertaining one. I offer entertainment.
Yes, you are. You definitely are cornering that market, Meltem. And so I think look, we're saying that nothing that hasn't been said for years on this call, right? Which is this is the challenge of proof of stake versus proof of work, right? In various ways, and then how you think about governance is the whole game.
I mean, to be fair, I think that's been going on for 3,000 years now.
Agreed. But the crypto community has obviously been cribbing. Yeah,
I think proof of stake has an interesting opportunity because of DeFi. That the underlying thing that provides security, if it's used also as collateral in a lot of these protocols, traders and everyone that's actually taking big positions, they're incentivized to calculate the settlement risk and systemic risk in these networks. And if there's actually financial incentive for it to be more decentralized, then that thing, that unit, that function of decentralization, that should be the preferred collateral instrument in all these networks. So there's this long-term bet that DeFi could save us, for us at least.
Mm-hmm.
Sam, I want to pivot back to something you said though. We've been talking about this for 2,000 years or whatever, and some of the stuff that Meltem pointed out. But as an investor, I guess starting with Sam, and then we can get to Meltem. But how do you evaluate some of these benefits and economic incentives between proof of work and proof of stake, and beyond just the proxy stuff? And how do you choose to invest in new protocols? I think that's a question that someone had in the chat as well.
I mean, for me, look, our background, Slow Ventures, we're kind of, I would like to think somewhat rare in that we're actually a generalist VC that sometimes gets invited to the real crypto parties, right? Whereas I think generally the crypto VCs and crypto community is at least currently very into their specialized ecosystem. But I'd like to think we get invited to a lot of the cool kid parties. But we basically take what I consider a very generalist approach, right? Which is first principles, ideas, and people. We invested, I'm very proud and very happy that we had the opportunity very early in Solana, right? Why did we invest in Solana? Because Anatoly and Raj are awesome, right? And because what they were saying, even in the earliest days before there was anything real, made complete sense, right? And we're we know how to do this. This is people and ideas, right? So I think, and I think that strategy has borne out very nicely for us in terms of, again, I think it's hard to lose right now in the crypto markets, but our portfolio is pretty great. And I think but it's all because we made very, very early bets on people and ideas, which is absolutely no different, right, than what we do in our generalist practice. In terms of how we got, look, I think that it's really easy, especially if you're a generalist or even just not a crypto specialist, right? And I consider myself not we're generalists, but we know a lot about crypto. You just have to put these things back on human terms, right? I think it's super easy to get spun down the rabbit hole, right, of how some of this stuff works or the relative advantages and da-da-da-da. But I think almost all of crypto, if you trust the math and trust the builders, you can really talk about the relative advantages and how these things work on very human terms, right? And so I think that actually, I'd say that my ability is if I can't explain on human terms why something is good or better or the relative trade-offs, then in my mind, I haven't sorted out what it does well enough or why it's relatively better, right? If that makes sense. And so that's, again, it's a very generalist answer, but that's kind of how I look at this stuff.
Meltem, what about you? in your perspective, both from CoinShares and just personally, and how you think about?
I'm basic. I'm a really basic person. If we look at the broad-based trend, right, at the end of the day, history it doesn't repeat, but it rhymes, right? So I look at companies like Equinix, right? They started in the internet peering space and helped enterprises who were new to the internet figure out how to navigate internet topology, internet protocols, routing, and build resilient, secure digital infrastructure. I think what Blockdaemon is doing, in my view, Blockdaemon is going to be the first crypto unicorn in the infrastructure space that is going to do the exact same thing. They're going to help people figure out how to manage, how to build, manage, and maintain their infrastructure footprint across these different networks. Like, that's just going to happen. Equinix is a $70 billion company now, right? Similarly, I think there's a huge amount of growth opportunity in this arena, particularly with the proliferation of all these protocols. So I'm basic. And then all we need to do around that, right, if we look at the broader trend, is how do we make that process more sustainable, since ESG is a huge mandate? How do we make it easier for people to understand some of the trade-offs in their decision making? And then how do we create sort of awareness for people who are fiduciaries and who are interacting with these protocols to talk about what they're doing in these human terms that Sam articulated, but also how do we start to quantify and qualify that? And I think Solana is a great example of a network where, like, what Toly's articulated about, you know, the design choices they made and what they're going through now. Like, this is an evolutionary process as well. You know, in crypto, we're very impatient. We want everything and we want it now. But at the end of the day, we're talking about a new behavior. And so I think the arc of time is very long, and change takes a long time, especially behavioral change. So I think it will take time for people to adapt these new behaviors and for this whole ecosystem to evolve and find its own sort of unique way of functioning. And certainly there will be analogs to what we've seen in other spaces. But to Toly's point, because you now have a financial incentive, for direct financial incentive, right? That's actually tangible for direct participation in governance. It'll be interesting to see, like, what participation rates and voter turnouts look like. It's interesting, like, the last election in the United States had about a 60% voter turnout. Protocol decisions, right, have wildly different turnouts, like as low as 2 to 3%, whereas the recent, like, Fey protocol governance decision about their launch and what to do with it had, you know, over 85% participation. So there's radically different outcomes, but I think this idea of coupling financial incentive with participation is an interesting, like, design area to explore. And I think we need to be open-minded. I've become much more open-minded over the last few years because I've been wrong about a lot of things. And being wrong about things is a great teacher as an investor.
I will say that being wrong, that tells me, like, when we invested in, and when I invested in Blockdaemon with Konstantin, he'll remember this. At least I remember this. Like, I love investing in things I find deeply ironic. And, like, I think Blockdaemon in the early days, it was like a deeply ironic company, right? Because you have all these protocols that are like, we're about decentralization and, like, not having someone control everything. And he's like, I'm building AWS. I'm like, well, that's pretty. So it's like, it's the opposite of decentralization. And so that's obviously flippant. That's not actually what they do, right? But I actually think that, to your point about being okay being wrong, I will say that personally in life, when I find something that's serious with great people doing it and good rationale, but is also, like, deeply hilarious or ironic, those are usually the best investments.
There you go. Yeah, and actually one thing I want to say also, just which I mean is true, and I think, I mean, anyway, but the decentralization part is a big one. But I do want to go back to what Anatoly said, because I think that's actually really interesting. The whole DeFi world and the stuff that sits on top of these layer ones now. That will actually change and structure a lot of stuff. At least that's what we see from the node layer. And so we're actually don't have a lot of opinions. We're very functional, right? And so the interesting thing for us is now you have the trend we see is lending, derivative products, and a lot of those look for settlement across any chain just very, very quickly. And so there's also this sort of abstraction inter-protocol world that's now getting born that sort of takes the best of different protocols, ideally over time. And so there's a whole new layer of complexity that's going to come in. And one of the things I always find ironic on the technical side is that there's a lot of theoretical thought on the financial and economics and very little thought on the infrastructure, right? And we always found that, I always found that ironic, because we have a very good view into the technical performance of these networks, and we've seen money thrown at networks where we're kind of like, the technical, like, this is just unwarranted and this will never scale. But people don't really look at, or didn't used to look at networks that way. And so I'm kind of curious, even though, to hear from like Anatoly how he thinks about that when it comes to Solana in terms of connecting. I mean, I know Solana, you guys are doing, one of the things we find fascinating about Solana is projects like Wormhole, integrating, Solana, Terra, Ethereum, bridges, all that sort of next generation stuff.
Yeah, there's like kind of interest, and there's always like two things you're optimizing for that are like fighting each other. One is that, like, people want lower latency, higher performance. It's easier to do that with smaller number of nodes. It's just at the same time, like, we need this really vast, wide decentralization, because I just can't imagine $1 trillion of volume happening in a network with 21 entities, with 21 machines, unless it's hyper regulated, right? Like, if we actually want this decentralized world, that number needs to be thousands, I think, so those are two things that they're fighting that makes it a really hard engineering problem. Bridges too, like, ideal bridges are fully decentralized. You're just dealing with the security risk of consensus between both networks, but that makes them slow. Like right now, a large part of that because Ethereum is just broken virtual machine that makes everything slow. And the other part of it is that it's really complicated to build, right? Like, any of these automations, if they have a bug in them, means that all those assets that are in the bridge are at risk, right, of being just lost, right? And when you have two new networks with potentially changing consensus parameters, how do you ensure that that never happens? It's just impossible. So like our goal is to kind of like, we tend to focus on shipping the thing that's going to be the fastest user experience first. So how do we make this thing the fastest possible? And then picking away at the security and decentralization and like improving those parameters. So we've been pretty successful at that, like including Wormhole, like is a Guardian-based network where you have, but that Guardian set doesn't run consensus. They're fully automated machines that don't need to coordinate outside of the two networks that they're bridging. So there's some additional security, like it definitely reduces risk. With our network, when we built this thing, we actually built a single node that was hyper fast first and got that to work. And then we made it at 100 nodes and then 1,000. Like let's get like the simplest thing as working as fast as possible, so that experience for like devs is great, and then make it as big or secure as possible. So I don't know. These are hard challenges. I don't know if we're doing everything the right way. We at least are able to, like, we have like a formula to prioritize decisions. Like, is this going to be the fastest implementation? And when can we ship it? How fast can we ship it?
Wait, Toly, you mean you're not going to solve 3 millennia of social governance issues in 1 year? What? Get it together, Solana.
We might actually solve it the fastest, because my strongest belief about the space isn't that layer ones and any or consensus matters. It's that the cryptography matters. Like we're empowering users with cryptography that's never been done before. Like,
yeah.
And all of these layer ones, it doesn't matter which one, as soon as you have 100 million people that know how to sign something, they'll find a way to coordinate it. It doesn't matter if they do it on Twitter. Like, it makes no difference if they submit signatures into Twitter and that's their blockchain. If they can actually verify those signatures and like see that the proof, right, the cryptographic certainty that 100 million people came to a decision is going to be a force more powerful than anything else.
Which is funny because we use Twitter in many ways as the attestation layer for a lot of blockchain projects.
Right.
Yeah, and one thing also just I'm curious about though, I think, isn't that the biggest risk for crypto? Because that's at its core, right? The cryptography, ubiquitous cryptography is kind of ultimately the promise here. But the huge influx of assets creates a world where actually maybe the largest commercial driver is going to be settlement in real time that floats on top of layer ones, which then creates these sort of wrong incentives actually to drive a lot of the financial upside. Because that's a lot what we see and talk to financial institutions about, is the actually what sits between layer 1 and layer 2 is becoming such a large financial potential bucket that the innovation is driven away from core settlement on chain.
But I think the other challenge there, Konstantin, is what's fundamentally different here is settlement with finality, right? Which inverts the security problem. So instead of trusting institutions, you have to trust the protocol itself and consensus. And so to Toly's point, like the cryptography and how consensus is reached, it is really important. I think it's always surprising to me when, and again, this isn't meant to be, pejorative, but a lot of people I talk to about cryptocurrencies, they seem to believe that like compute and connectivity just exist in the ether, and that's not a pun, right? Like every network has capacity constraints, and compute and connectivity cost something because you're running somewhere, no matter what your form of consensus is, whether it's proof of work or proof of stake or proof of space and time or delegated proof of authority, like no matter what your consensus mechanism is, somewhere there are semiconductors running and there's electricity powering them. Like that is a fundamental truth, and that requires physical infrastructure. And so what's been interesting to me is like, for some reason, so much of the focus and so much of the money in the space has gone towards abstractions of that, either the protocols or the companies, but nobody's really injected capital en masse into this really foundational layer of infrastructure. That's the industry I come from. I come from the energy industry, where I used to build like 10-year-long, really massive multi-billion-dollar infrastructure projects. Like building an LNG train in Papua New Guinea is very similar in many ways to building compute infrastructure to support entirely new blockchains, because there's nothing, right? You're literally going to the jungle with a suitcase full of cash trying to figure out how to build something. So I'm really excited over the next like 5 to 10 years to help popularize this notion that a blockchain, like a network, has physicality, and managing that physicality and investing in the robustness of that physical implementation of the network, which is what provides the security, right, along with the community and the social capital, is so critical. That needs to happen. It needs to happen now. And by the way, if anyone here is in the world of policy, infrastructure spending bill, let's get some infrastructure spending capital into the crypto space to secure these networks, because it's really important. It's going to create a lot of jobs. Totally. You have something to say on that?
What's something tangible? What's something tangible then that the investment can go into?
We internally joke that we're going to optimize this thing until we have to build neutrino-based detectors to go through the core of the Earth, because that's going to cut the latencies down, and that is like the pinnacle, I think, of like communication infra, right? Is building like a new physical transport layer that is faster than satellite, goes through the center of the Earth for all paths, building a super connected world. So,
but also obviating the need for clocks, right? Which is like ultimately the aspiration of the Bitcoin blockchain, the time chain, right? We will keep time based on consensus, and we can sync like across different time warps in the fabric of space-time.
Time is a matter of consensus is pretty funny.
It is though. Like it's crazy.
I totally understand. It's just a funny. You go in the category of ironic ideas that Sam would invest in.
I'm here for the entertainment value.
That crosses the. Well, the good news about you and me investing together is you like entertainment and I like irony. They're very related.
Indeed.
So, what's something ironic or tangible you can invest in next? What's missing in terms of node infrastructure? Open question for anyone, and then we can quickly hit the rest of these questions in the chat.
Again, I'm actually curious what Konstantin thinks about this, and Anatoly, and well, everyone really. I feel like every 4 years I run my own nodes, and then I stop because it's a pain in the ass. But every 4 years I go out and I try to run my own nodes. Right now, I have running in my basement. I'm doing some chia farming. Which I'm actually, for what it's worth, not to shill another project we've invested in, but I'm actually really excited about Chia. I think Chia is going to be super cool, and I actually think there's a lot of interesting stuff going on there. And it's one of those things that, like, on the servers, you're like, oh, this shouldn't be that hard. You click a button, it runs. You plot some shit, you farm some shit, life is good. In practice, it's really fucking hard. And like, that's not a slight. I mean, I think it's still interesting. I think going to be a I'm very excited about it. But like, it's like, fuck, I'm going to burn out my solid state hard drive. And like, now that my solid state hard drive, plotting. And then it's like, oh my God, like this is just like the pipeline of how you actually do this and get it set up. There's then like all these things like, oh my God, you know what I want? I want someone in San Francisco to run a plotting service for Chia, where I can just go buy hard drives that are pre-plotted and plug them in, right? And I would like actually pay a fair amount of money for someone to just like deliver me plotted hard drives, right? Ideally, that I could pick up for cash. Like how crazy do you want to be? Like, but like I think there's like,
but Sam, let's put those hard drives in an opportunity zone as well.
For sure. Why not? Like but my only point is that like, I actually think, as I believe in nodes as a service, I think what Konstantin and the Blockdaemon team is doing is both practically awesome. I'll shell for them for a second. Like it's practically awesome. Like they do a lot of shit for me and like slow. They do it great. The customer service is awesome. They've definitely saved me from making a bunch of mistakes and kept me peace of mind for me on a bunch of things that I care a lot about. So like that's awesome. But the whole vision of like I can consumer mining, setting aside proof of stake, but it's a different form of like how you secure a network, I think is like in this space of like ironic, interesting, whatever. And I suspect that we'll see that. I mean, you have like, I'm interested in Space Mesh is doing something weird with this. Like there's some other cool stuff I think that'll happen. Personal viewpoint in terms of weird shit.
Yeah, I think from my perspective
is interesting for that, right? Like, I mean, there's interesting other forms of like mining and consensus that I think are interesting.
Yeah, I think from our perspective, ultimately, open source tooling that's qualitative and integrated, right? And so I think where the problem is that all these ecosystems are unique, and they're all actually fairly small on the developer count side. So you have like 100 developers building on an ecosystem. You don't have a tooling infrastructure that's plug and play enough to allow a guy like Sam to also do this himself, right? And so for us, over time, the way we see this evolve is that the institutional grade infrastructure we build, it's a little bit like, when companies, big car companies do Formula One racing. It's kind of a little R&D function that then gets open source into mass products, and so ultimately for us, that's sort of what we do currently for large scale institutions, and then open source tooling, participate in the respective projects to allow individuals over time to actually, we have a product called a package manager. You can throw it, it's a script, you throw it on any Linux OS, it deploys a perfect node, like stuff like that. Ultimately, I think there's a lot on the tooling side that needs to happen.
Anatoly, from your perspective?
Consumer mining and stuff shouldn't be the focus of a network. It's like the second wave. Like they need to like get their like people, like the people that geek out on this stuff, and like find every micro optimization, make this the cheapest thing possible, build those first FPGAs. Those should be like the core things. Maybe Chia's already past that, but like for us, like the folks that we see contributing a ton back into the ecosystem are like people that like call up data centers in Russia and like figure out that this particular thing actually has like high bandwidth, even if it's in like a shack somewhere in Siberia, right? Like and like get that set up and like actually like decentralize and distribute. Like consumers are not going to do that yet.
Yeah, but there are marketplaces.
Okay.
Compass Mining is doing this in the Bitcoin space, right? They're allowing people to source hardware and then co-locate it in a managed facility. I'm interested to see, just more choices. And I think Blockdaemon actually is really well positioned to have these different models where you can run your own bare metal, you can run hosted services, you can choose which cloud you want to run it on. Like there are just so many factors. Again, what we go back to, nothing is decentralized at the end of the day. So you just have to choose like which vector of decentralization is most important to the long-term viability of whatever it is that you're excited about. And so, I've always felt like, there are going to be waves, and I agree that consumers aren't the first touch point. Like we can barely figure out how to sign our own transactions, like how to use public private key cryptography. Like let's do that first, and then we can teach people how to run infrastructure. So
So I agree, but I was asked what's like weird and different. I'd say that what you guys are representing and talking about is like correct, like from any like practical perspective. But if you look for irony, right, in the world, right, I think that is like an old theme, right, that's currently very out of vogue. And because it's so out of vogue, I kind of like it.
I mean, Coinbase is a bank, right? So like we're full of irony in crypto. There's nothing new under the sun. It's all good.
There we go. I think that's a good stopping point. I think that's basically the theme of today's talk. But thanks everyone for attending, and thanks for the panelists for joining. This was fun. I think we'll have both the slides and the recording up end of day. If not, look out for that. But yeah, thanks for participating today.
Thanks, everybody.